Hi, and welcome back to Mike on Money. My name is Mike LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And here's where we talk about everything that is financial every week. We take deep dives into specific subjects. And this is actually part two of a three-part video where we're talking about our number one question we get from clients and from people at large is, how do I invest money? So what do I buy within a portfolio? So we're going to look at the $100,000 level. A previous video, part one, we looked at million plus, how to look at it. We look at it a little bit differently depending on the size, and that's just to keep things safe. So before we dive into that, as always, keep in mind, everything we talk about in these videos is for information purposes only. Always seek the advice of a professional, or do your own due diligence before applying any strategy, any portfolio strategies, or applying anything that you might learn here to make sure you've got the most current information and the ones most appropriate for you. With that, let's dive right into things. So you've got a portfolio of roughly 100,000 or more, and you're looking at invest in that. So as we mentioned previously in our part one video, the number one thing, and we're not going to talk about it in this video, but the number one thing is to do a financial plan. Figure out your strategies, identify your goals, and identify your risks. Most important. We did a whole video on that, so I'm not going to dive into it here, but you can definitely click one of our links and you will be able to watch that. And I highly recommend you do that as well right after this, or pause this, watch that, and come back. So once you've got all that figured out, you're going to build your portfolio around those parameters that you've set out. So when you're building building a portfolio 100,000 or more, the first thing that you want to do is identify kind of what asset classes you want to put in there, whether it's going to be fixed income, whether you're going to have, how much you're going to have in equity, and really important to look at foreign equity and domestic equity. If you're looking at spending your money in Canada, we always have what's called a domestic bias on the portfolio. And that's not that we think Canada's better or more opportunities, is that you're going to be spending your money in Canadian dollars. And every time you invest outside of Canada, you're always layering in what we call currency risk. So do be careful with that. It's always good to diversify outside of Canada. There's some great opportunities around the world, but keep that in mind, is that you do have to take on some currency risk when you do that, or hedge for the currency when you are doing your investments. And we'll touch a little bit on that. So once you've done that, you want to look at what kind of product, what kind of tools you're going to use within the portfolio. Definitely the 100,000 above, you can start looking at individual securities. And when I say start, it's really all about diversification. So when you're doing individual securities, if you have 1, 2, 3, 4 different names in there, versus having 25 different names in there, of course, exponential risk goes the fewer names that you have, and you're not really being properly diversified across the sector or even across the different asset classes. So be really careful with individual names. They're great to have. You can add a lot of growth into the portfolio by having some really strong stories in there, or particular sector exposure by doing individual names. And you're definitely at the level that you want to start considering that, or definitely applying it. So let's talk about that. When you're looking at your portfolio, shouldn't say no matter what your risk, but most people at different risk levels, having a little bit of growth story in the portfolio is not going to hurt you. That doesn't mean 20-30% of your portfolio should be in that if you're more risk adverse, but 1, 2, 3, even up to 10%, depending on what your risk profile is, won't hurt. It'll add some growth, it'll add a little bit of torque in the portfolio, and you can put some really interesting names in there without taking on a ton of risk. Now, I talked about this in the other video. My favorite way to get that torque, to get that growth without taking on necessarily that speculative type of a position. Now, we're not talking about penny stocks necessarily. We're not talking about startups. They can be really mature industries, but there's always those people who want to have like the high torque, the high growth stocks, your Amazon story, or your Tesla story, or your Shopify here in Canada, which would be a competitor to Amazon. But picking that next Amazon stock is going to be really hard. There's a lot of them out there trying, and a lot of them aren't going to succeed. But if you really think that space is taking off, take a look at the companies that are going to service that industry. Our favorites that we've used in the past are Visa, MasterCard, and PayPal. Of course, those are all online payment options for you when you're shopping online. So those are great ways to leverage off that without necessarily taking all the risk of being in that particular sector or trying to pick the next big, huge winner. That's the same with 5G. If you like 5G, a lot of infrastructure's got to be built to roll that out. A lot of cell towers have to be rented, so that's real estate holdings that you can go after. A lot more stable sectors, a lot more stable revenue, but still will benefit from the underlying technology without having to pick that one winner or there's two winners that are going to come out of that sector. So that's where you can add some torque in the portfolio. Don't be afraid of it. It's a great way to enhance the portfolio. Don't be afraid of ETFs. Some people will come in and they won't want to have ETFs in the portfolios. And maybe that's because they've heard a bad story about mutual funds, or maybe they've had some bad experiences. And we'll talk more about mutual funds in a second. But ETFs are great. They're very, very low cost these days. They can get you some incredible diverse exposure, especially if you're going to a particular sector that you want exposure to, or if you want to get out of country. There's a great way if you want to get some foreign investment in the portfolio. Use the ETFs. Not only do they give you cheap diversification to a foreign market, but you can get most of them come with a currency hedge built in, or an option to have a currency hedge built in, which means it takes all the currency risk out. You might not want that if you're bullish one way or the other against a certain currency, but if you want to be protected against that, most of them have an option where you can, or most of the major ones have an option where you can buy a currency hedge version, which takes that risk out. So you buy in Canadian dollars, so there's no FX charge or exchange charge. And if the currencies go opposite way that you think, it's not affecting your returns. It's really about what happens to the underlying portfolio in that home currency. So that's another great tool to use, is the ETFs in there. So mutual funds we mentioned. Should we be using mutual funds? I'm not a huge fan of funds at this level. Now that's with a caveat in that there are some great situations where mutual funds bring the value that you want. Sometimes in tax strategies, sometimes within corporate accounts, sometimes just specific strategies, or especially when we talk about alternatives we'll get into, they can bring in some added value. But in general, they have a higher cost structure. Nothing against funds themselves. They just do have a higher cost structure. And at that level, you don't want to be paying that higher cost. So, really look at if you can duplicate what you're trying to achieve with an ETF, if there's one available, and generally there always is, you can get it at a much lower cost than through a mutual fund. But again, this is where the due diligence and the professional advice comes in. There may be a very, very good reason to have a particular focused mutual fund in there if it's bringing you extra value beyond what you're paying in fees, in which case definitely have it in there. We often see sometimes some of the other financial institutions, the banks in particular, will have these pool solutions where you have these pool funds. Again, not a big fan. Some of them have layered fees. You also don't have individual control over those, which means your tax situation, you wouldn't be able to tailor make or at least manage your tax situation like you can in a custom built bespoke solution of a portfolio, which could get you into a little bit of tax problems down the road, or not problems, but just paying some taxes maybe at an inopportune time, when if you have a more customized or bespoke solution, you can time those a little bit better with what other things that are going on in your life, maybe a bonus at work, or you've sold some real estate that you've had some big capital gains on, or things like that. So I generally don't recommend those, but if you're in them, doesn't mean that they're horrible. But if you like to have a second opinion, we'd happily look at it, let you know exactly what the fee structure is, whether that's a value to you or not. It may be, and it's worth taking a look at anyway. Also in there, you should really consider alternatives. So alternatives come in all different flavors and classes these days. You can have debt alternatives, you can have the hedge alternative equity type of investments, the long short type of investments. You can have on the debt side, your fixed income side, you can have your credit spread alternatives. They come in all variety, and the goal of the alternative is to be negatively correlated to the markets. So that basically means if the markets are going down, they don't go down as much, or they might even be going up, dependent on what strategy they are. The idea is that they're not going to act the same as the underlying equity or the underlying debt that you're buying. There's also some that focus on private issues, might be private equity. Great strategies to have in portfolios. Do be careful about liquidity because they're not always as liquid as normal, especially on the equity side. And also alternative debt is also something else to consider. Doesn't mean higher risk. It usually means a niche area, very unique situation where you'd probably get a little bit higher yields than you would if you went out and just bought credit on the market. But it doesn't mean more risk. It does mean more due diligence. It does mean more research either by your advisor or yourself to make sure you're buying good quality and the managers have great experience. But it's worthwhile looking at that. You should have some of that in your portfolio, especially in this day, a really low interest rate market. You want to take advantage of those inside your portfolio to get your maximum returns. So with that, that gives you a broad range of what to look for in investing 100,000 or more. Again, look at those outside. They're not sexy industries, but there's always a service side to whatever underlying sector you're looking at buying. Always great to layer those in. No one's talking about them. They tend not to be overhyped and overvalued and much more volatile, but you can get some really, really great returns and usually better cash flow out of those types of names than you can out of the speculative names that are in the big press out there. So with that, I'll leave you with that. Do sign up to subscribe to our channel. If you like it, let us know. If you want to hear a different topic, please send in your comments. If you'd like to hear more information of how you can put this into action in your own portfolio, reach out to us. Subscribe to our weekly report where you'll get notification of all our new videos that we put out, but also a weekly update of everything that's going on. And don't forget, every Tuesday at noon BC time, we do a live weekly market report where we try to keep you up to date on everything that's going on in the world, but also try to give you some advice as to what's changing out there in the markets. With that, thanks very much, and we'll talk again soon.